Hi, Brian. Welcome to Venture with Grace today.
Thank you, Grace. Thanks for having me.
Uh, since we talk about like not using Chinese as like the default language here, so I will give you a shout out on like your Chinese skill is like absolutely amazing.
好，谢谢。
Oh, this is it. Okay, so let's start with like maybe give the audience a little bit of your background on like how you started your career in venture and what were some lessons that you've learned early on in your career that like lead you to becoming like a partner today at CoVenture.
Yeah, sure. So it's definitely an interesting journey. I started out getting interested in the venture ecosystem actually in college. And funny enough, in China, I spent my freshman year summer working for a consulting firm in Beijing that was focusing on angel investing and working on some early stage innovative companies. And that got me interested in saying, oh, well, obviously that was a very unique place to be doing it. Let's see what that's like, sort of based in the US. Spent a summer working at a growth stage tech startup in the Bay Area. And then during college, I met the founder of CoVenture, Ali Hamed. He and I started just working together on different projects. He was getting CoVenture started up while we were in college, and I was helping out for free with whatever he needed help with sourcing, putting together market research presentations. And that's where we ended up doing a lot of work in colleges. I was talking to the professors on campus, utilizing university resources, talking to founders, and just like putting together information across different sort of categories. So that ranged from an elderly care thesis that was built out to marketplace infrastructure. And it's fun to look back at those presentations from 2014, 15, see what we got right, see what we got wrong, and sort of go from there. But that built the foundation. So for 2.5 years, I was working very close with Ali, worked with a couple other venture capital funds through that process as well. And then ended up wanting to get a little bit more of a technical skill set. So did investment banking for a period of time, which allowed me to at least build some more confidence in financial modeling and financial analysis. And then rejoined Ali once we had raised a little bit more capital on the CoVenture side to help build out this credit investing platform, which we'll talk about more today.
Totally. So I feel like you are in a very interesting like side of venture. So basically, okay, let's talk about like, previously like you have co-written like or like helped written a few articles in the venture debt
Mhm.
space. So let's start with like, can you elaborate more about like the debt versus equity in the
Yeah.
venture space? And then what kind of things are you excited about in your space?
Yeah.
In
So
general.
it's really interesting. So when you think about the range of options to early stage venture-backed businesses, you traditionally would think, oh, these businesses are risky. There are largely binary outcomes that relate to a lot of the businesses that are raising capital. And so venture capital is the correct form to actually raise that in. It's very high cost of funds for the founder because they're selling a lot of their company at a low valuation with the hopes that they can grow the business and make themselves and the VC fund a lot of money over time. That type of risk profile does not favor debt investors usually, right? Because
Mhm,
debt has a fixed upside. Inherently, the most you charge is your interest rate. And even if you see like, oh, it's a 12% interest rate, 15% interest rate, that's so high. When you compare that to the cost of funds for venture capital, where they have an unlimited upside, it's actually really significantly less than that. And so the next iteration within the venture community was venture debt, which
mhm,
is different than what we do. But venture debt is the idea we'll lend to a startup against their enterprise value or against the future likelihood of them being able to raise capital. And so that's what SVB and Hercules, WTI, and a bunch of other firms do that, where you're lending to a company against the enterprise value of that business and getting some warrants, and you're attaching it to the parent company. So it's like a corporate loan for a venture-backed business. Where we sit is what's called asset-backed lending. And
mhm,
so this is a little bit more novel to the venture ecosystem as more and more lending companies are becoming fintech origination businesses. And so what does that mean? So instead of lending to a company against the parent company, its IP, its cash that it's raised from its venture capitalists, you say, all right, these fintech companies that are originating interesting assets have to capitalize that differently. So for example, if you're making a loan to a consumer like Lending Club would back, that's sort of one of the early fintech origination businesses, they might be earning a 15% interest rate on that loan. Raising
mhm,
venture capital, which has a really, really high cost of funds, wouldn't make sense for doing that because you're selling a big piece of equity in your business for something that has a 15% return on equity, return on asset.
mhm,
So it says instead of doing that, let's set up a structure that's been used for securitizations in the past for larger, more mature companies, where we borrow against those loans that we're making. So if we make $100 of loans, we might be able to get $95 from an asset-backed lender to actually make those loans, rather than having to use precious venture capital dollars that should be going towards research and development and working in sort of sales, working capital, you name it. And so setting up this separate entity like that holds all those assets and they can borrow against that.
Mm. I wonder, I know that you guys work with some of the bigger like creator related things as well as like
Yeah.
some of the I would say like Amazon, Shopify type of businesses. Can you give us a general overview of like what type of business would be the perfect fit for this category of investing slash debt?
Absolutely. Yeah. So I think the thing that we became really interested in, actually, the first week I was at CoVenture, I spent a week reading all of the CFPB's reports about payday lending and title lending and all of these things, these boosted practices that existed within the ecosystem. Read a bunch of books about financial inclusion. It was very clear is that there was a lot of areas that have many people that are earning money on a personal basis, or small businesses that were earning money in new ways, but they were shut out from the traditional financial services ecosystem. And so we viewed that tech and the introduction of certain data sets would allow those individuals and businesses to access financial services in a way they previously weren't able to do so. So you mentioned sort of the creator ecosystem. YouTube is a perfect example of this, right? So YouTube as a platform has really only existed for 15 years. The monetization and consistency of that monetization has lived for a little bit shorter than that. And if you look at that ecosystem, that's like $60 billion of ad revenue being generated. So it's massive. But when we first made our investment in a company called Spotter, like the creators that they were working with were like, I want to get a house, but I can't get a mortgage from a bank because the bank doesn't know how to underwrite my YouTube revenues. And so like, how do you think about where the banks aren't playing? They're not there yet. They can't underwrite a YouTuber's revenues the same way someone who specializes and focuses on analyzing, predicting YouTube revenues on a go-forward basis, and actually understanding whether or not a YouTuber is growing or shrinking and things along those lines. And so that's an example of how we say we're utilizing data to better, find, which means origination and finding the deals, underwrite and price and understand how to actually figure out what the risk is, and then service, like how is technology able to help you better collect on those receivables. Another example would be a company called Returnly that we worked with in the past. And the idea that Returnly had was, if we can offer an instant refund to e-commerce customers who are purchasing an item but need to return it, whether it's exchanging a size or want a different item, if we can offer them an instant refund versus having to wait 2 weeks to get the refund, they were going to increase the likelihood of a repurchase by like 4 times, some ridiculously high number. And they were going to buy a higher value basket and all these different things that were like very, very interesting. But they had to underwrite the ability for a consumer to return a $150 item, let's say. And so how do you do that? Because you can't use an individual to underwrite a $150 claim. The cost of underwriting it would be too expensive, and it would far outweigh the benefit and the fee that they could charge. And so they had to create technology to underwrite that automatically. And so they were able to automate the whole entire process and keep default rates really, really low, like way lower than you would expect. And that's all because they were able to automate and utilize data to better underwrite, and also in that instance, originate through their software platform, underwrite, and then service the assets that they had there.
I wanna like, since like you guys are doing something very innovative and like nobody has a benchmark in the past before, I wonder what is the diligence level? I guess like what does a due diligence look like when you are evaluating the assets. So for
Yeah.
example, let's say using the YouTuber who is trying to buy a house as an example, I guess like what kind of benchmark they have to achieve. Is that, for example, let's say like a Mr. Beast or something, or is that more of, let's say like a smaller YouTuber with maybe 100K follower, their view is at X amount that will generate X amount of ads due to this view number. I guess like what does a diligence level, diligence process look like for these type of companies?
Sure. So the thing that we like to do is we like to find very smart people with a lot of domain expertise who understand these asset classes really well. So I wouldn't feel comfortable myself saying, hey, this is how perfectly you underwrite a YouTube video or how to identify talent. Like, we find people that are really smart, have built sophisticated underwriting models and ways of working with these individuals. And they were underwriting their ability to underwrite, if that makes sense. And so we spent a lot of time pressure testing, looking at the underwriting parameters, looking at the risk guidelines of all of the different platforms that we work with. So for Returnly, you say, all right, these are the different things that have worked historically. We're going to look each month to make sure the performance is within the expectation of what we had set out at the beginning. The same thing for someone like Spotter, looking at how they're actually projecting out the revenues and saying, does that make sense? Have they done back testing? Have we pressure tested that in ways where we still feel comfortable that our capital is safe if there's some deviation from the expected return that we had previously underwritten to?
In terms of like, I guess like, for example, when I like, as a traditional VC, we typically talk about like how they actually find the deal, what like basically find the deal, evaluating the deal to winning the deal and to exiting. I guess like I don't know if it's like appropriate for question to ask in the debt landscape, but can you
Yeah,
walk us through maybe, for example, the companies that you've mentioned, like the Spotter or like other
yeah,
companies that you mentioned that can you walk us through like how did you first encounter the deal, and is the deal pipeline similar to like a venture deal pipeline, or is there any particular area that you guys would really go hunting
yeah.
to can you just basically just walk us through a deal that you've done, that how you think about them, how you think about liquidation and everything?
Yeah, no, it's a very good question. I think like one of the unique things about our firm is that we spend a lot of time in the venture ecosystem, and so our primary sourcing channel is venture capital network.
Mhm.
And so I always like to say we have all of the structure and credit experience across our team of a lot of people with 20 plus years of credit investing experience, but we're able to bring the bedside manner of venture capitalists, which is obviously very different than traditional credit investor, who I think is a little bit different than who is the founders are used to interacting with. So I'll give a shout out to Jeff Weinstein at FJ Labs, who sent me both Spotter
Mhm.
and Returnly. So he and I have done a lot of deals together, but that would be an example of we work closely with different venture capital firms and we trade deal flow on different deals from that angle. There's also we keep our CRM pretty organized, but we have a lot of deals that we source through our limited partner network. A lot of our investors are former founders or financial services professionals who see early stage deal flow that is actually quite relevant for us. And
Mhm.
then we have a lot of direct relationships for people that were C-suite at previous startups that reach out to us. They say, "Hey, I'm getting something going myself. Would love to talk to you about this." Or my favorite is when founders in our portfolio refer their friends who are founders to come work with us, because that's the best validation when you say, "Hey, I'm a customer, and I think you should be a customer
Mhm.
too." So we love that channel.
Mm. I wonder when it comes to evaluating the returns, since venture is based on like the high risk, high reward model, and but like I wonder what does a debt um, ecosystem like look like
Yeah.
for as for like from a return perspective? What would be like a good benchmark that you are using to say this is like a giving us a really good return? And then also for the venture portfolio construction, it's typically every deal should have the likability like to return the whole fund to a
Yeah.
degree. And I wonder, does this apply to your fund?
Yeah, yeah. So we still have the same issue that a lot of lenders have, which is there's a fixed upside, right? It's just
Mhm.
based off of the interest rate. Maybe there's sometimes warrants attached to some of the deals, but largely your cost of capital is fixed in the upside, and so you have to build a portfolio that is durable,
Mhm.
where you're not going to have any losses or zeros, right? In a venture portfolio, you could have half the fund go to zero and it could still be a 20x fund because there's one or two, the power law, right? There's one or two
Mhm.
deals that actually drive the entire portfolio.
Mhm.
In our business, we could think about that in somewhat similar terms of like origination. So we back, let's say 20 companies. Some of them might, originate a ton and buy a ton of assets, originate a ton of assets. So like Spotter, we mentioned earlier, like they bought I think over $800 million of YouTube videos or licenses. And so that's a business that scaled tremendously. They found product market fit. They got the equity behind them and they grew really quickly. In other instances, we'll back companies that draw $1 million or $2 million, and that's sort of the nature of it. Is that we spend a lot of time with companies. We'll go early, and we do our best to underwrite origination and like their ability to originate. And some will scale and some won't. So I'd say like we're always focused on protecting the assets whenever we underwrite a deal, And I think in certain instances, we'll take risk is whether or not the company will be able to originate and actually scale to what we think it needs to be.
Mm. I guess like in terms of for the company to scale,
Yeah,
what would be the stage that you would enter the game, and then what would be the stage that you want to liquidate your portion of the debt?
sure. So I'd say anywhere between seed and Series C is where we're coming in. And a lot of it just depends on, do we like the assets? Do we feel like the company has enough equity to support the assets and service the assets? And a lot of it will depend sort of on the duration and like our ability to feel confident that these guys are going to be able to actually grow the portfolio the way we think they're going to grow. And so I would say as far as exiting the positions, we like working with people as long as we can and as long as we can stay relevant. At a certain point, businesses are optimizing their cost of funds and getting ready for an exit or an IPO, whatever it is, and they need to be able to show improved unit economics. And that's when they start thinking about cost of capital. But along the way, I think we've proven ourselves a really good partner, understanding businesses, helping them adapt and evolve how they originate and what types of assets they originate, where even we continue to work with companies as they scale through that growth phase. And then
Mhm.
later on, I would say probably as you get past Series CD, that's where it's most common that you have a real professional capital markets experience where you come and start thinking about securitization or cheaper forms of capital.
I wonder what as a um, terms typically look like? Let's say if you work with a company, obviously you don't have to disclose if it's like a sensitive information, but can you give us a general structure of like, since it's debt, so there's like loans, and I wonder like how does it work? Let's say I'm a content creator and
Yeah.
let's say I reach X amount of views and I come to you to be like, hey, we want to maybe purchase more equipment, or we want to
Mhm.
make like Mr. B style videos. It's gonna cost like, I don't know, like $500,000 for us to build this like
Yeah.
fake I don't know, like castle or something. So I
Yeah.
wonder how would you can you just walk us through the process of like what will we be um what kind of conversation we'll be having if we are potentially working together?
Yeah. So we're working mostly with platforms, right? So
Yeah.
in that instance, if you came to me, I'd say, hey, we've our good friends at Spotter would be great people to talk to about, their business.
Mhm.
For let's say you're a company that's the next iteration of these. You're a credit card receivables company, you're a tech-enabled factoring business. We talk to that business and we essentially spend the first 2 weeks really understanding what they do, what they originate, get the data on the historical performance of what they've worked on, understanding of their equity backers, understanding of their runway, understanding of the unit economics, and from there we do financial modeling to say here's the pool of assets, here's how we think they're going to perform based off historical data. Here's how we think they're going to perform based off of proxy data sets. So, for example, if we work with a credit card origination business that has 700 FICO, they might have one loss rate. And then we would go and look at securitization reports or publicly available data and say, what does historical loss rates look like for 700 FICO credit card receivables? And so then we'll come
Mhm.
up with a base case loss assumption and figure out like what is the appropriate amount of leverage we can provide to the originator for their origination of these receivables. And so that might say, hey, we have to be able to have enough margin of safety if our base case was wrong by 2 times. And so then we come out and say, well, here's the structure that we would propose. If performance proves good over time, maybe there's ways of improving the amount of leverage, meaning that if they originate $100 of loans, we give them $90 of debt, that they have to just put up $10 of equity underneath our $90 of debt. Or that number is sort of variable based off of how confident we are in the performance of those underlying loans. So that's how we think about structuring is like
Mhm.
how much leverage are you actually providing against the assets that are being originated? So that's oftentimes the most important conversation, even more so than rate. Rate's obviously a big one. Is like do the assets that you're originating support the cost of capital that we have? So if you're originating a mortgage that's 7 or 8% APR, that doesn't work for us because our cost of capital is above that, right? But if you have a higher yielding, sort of like more interesting type of product that's special situations that we can roll our sleeves up in, then it becomes something that we can spend more time in looking at, because our cost of capital actually matches that, and it still can be unit economic positive. So oftentimes we say, like, what are the right assets? What's the right amount of leverage? What's the right rate? And then you come up with a loan structure. It's usually 3 or 4 years in duration, that we're providing to these companies, and work around the parameters from there of, like, what can you actually originate? So, like, can you work with, so if we want to say for the return examples, like, you can't do returns that are greater than X dollars, or you can only do returns on companies that are in X geographies. And so that way you start building a parameters and buy box in which people can just originate directly out of and don't have to come back to us every single time they want to know, hey, can we do a loan here? Can we do a loan there?
Mm, I wonder, like, so in case, in terms of like having these diverse set of different companies, I guess, like, how do you spend your time on like figuring out which subsector
Yeah.
that you want to spend more time on?
It's a very good question. I think it sometimes is comes to us, and sometimes we observe the problem and we're like, okay, we have to see whatever is there. So the creator economy was an interesting one, because during the pandemic, a couple close friends of mine became full-time content creators. And so personally, I was very obsessed. I'm like, how do we create a financial ecosystem that actually supports these creators who have very different ways of earning money than traditional, traditional people who are like having W-2 income, and it's very predictable. And so I spent a lot of time. Obviously, YouTube is a big platform, and saying, is there any other ecosystem that exists within the creator economy that is producing predictable revenue, where you can provide capital in a way that's debt-like versus equity-like? And that's oftentimes the easiest way. So I spent time looking at Instagram, TikTok, podcasts, and a lot of it was unpredictable, right? We'd even looked at a deal that was providing financing to like Roblox, creators who were generating content, and these creators were generating a lot of money, but the predictability of the revenues was not yet there to support some sort of financing product similar to what Spotter was offering for YouTubers. So in that instance, it's fine. Hear about a problem, whether it's a personal or you hear about other people who are approaching it, and how do you dig in? How do you like spend a lot of time researching, putting content out there, and figuring out, like, are there other platforms of predictive monetization that you can actually create products around? So I'm always thinking about, where is there predictive monetization? How can you finance businesses or people who are in that, sort of in that mix? And so we've spent time in other verticals like construction, finance, prop tech. There's a lot of opportunity there, because that's obviously a massive marketplace. Healthcare is a place we spent a lot of time in that healthcare, high deductible healthcare plans have created a lot of issues and inefficiencies for individuals who have high deductible healthcare plans and can't afford certain out-of-pocket healthcare procedures. So we spent a lot of time figuring out, like, what are the best ways of actually solving that problem for consumers. And so sometimes it's, you see the problem and you provide the solution, or you start to see a bunch of companies that come in all at once, and you're like, okay, there's clearly a trend here. Let's talk to 20 different companies that are doing it, or 10 different companies, and figure out which one we like best, and back that player.
Mm. Since like I feel like I wanted to touch upon like the basically you just mentioned like a diverse portfolio of companies, and like
Yeah.
I was browsing like on your portfolio. You have, for example, the healthcare company you mentioned. Let's say the patient. I don't know if
Yeah.
that's
Yeah, that's right.
okay. So let's say, for example, this sector is very different than like the YouTuber licensing, creator licensing
Yeah.
kind of services. And I wonder, so in venture, like people would exam like maybe like a 5,000 deal per year, like, and then they invest in like 10 top. So I wonder for your sector, like, would you say, so you mentioned about like during the pandemic, you would like browse a lot of like creator subsector related things, and then I wonder how would you go deep into a subsector. Let's say, for
Yeah.
example, for if we're talking about like the patient company, like, so for example for healthcare, um how do you quickly understand
Yeah.
how does the money flow in the industry, and then how do you evaluate if that particular problem this company is solving is going to generate revenue, and
Yeah.
what kind of like diligencing um, documents or like information that you need to see before you feel comfortable examining it.
Yeah, no, I think it's one of the most fun parts about the job is, like, it's very liberal arts in the nature of, like, you're always learning about a new industry, you're always spending time on it. I think oftentimes it starts with a really enthusiastic founder. So Brian at Patient is obsessed with solving this problem. And so when I was talking to him, I was like, you're learning so much, and he doesn't mind that he's educating you and spending time to get you up to speed because he's so enthusiastic about the problem. He's like, I don't care if I'm giving you this information for free. Like, I really just want to solve this problem no matter which way it is. And he obviously wants to solve it ideally through his company, but we spent a lot of time together learning about it, and then spent time with sort of other folks in the space, people that were in different value systems, whether it was folks that were trying to solve the problem, people that worked at hospital systems, people that worked at insurance companies, people that worked in adjacent type of businesses like third-party administrators within the healthcare space, reading a lot of reports, and then in certain instances using third-party services, expert networks to help learn more and more about the problem, but just reading, and then blogging, getting some things wrong, people telling you what you got wrong, doing more research, having conversations with those people, and then continuing to just refine and adapt the thesis over time. And one of the things about Patient that we thought was so interesting is they were solving the problem in a way that was a win for all the parties involved. And it was one of the unique groups that was actually doing that in that way, where a lot of other people were either taking advantage of the employer, taking advantage of the customer, or taking advantage of the provider. And I think they created a really healthy balance amongst those three constituents that allowed them to create a really attractive product for all parties involved.
I wonder, so like, I guess like when you, for example, you have invested in like multiple company in the healthcare space. So, or like the medical space in general.
Yeah.
How do you, I guess like, would you be like doing the thematic approach, which is like, oh, let me chat with, let's say like 40 healthcare people, companies, and then I identify like which one would be profitable in terms of like in the depth space? Or is there something that's more of like a founder focus, like you chat with a lot of founders and then there may be some business that you can do with X founder, so it's like a numbers
Yeah.
game,
We
founder approach?
Yeah, we like to talk to as many companies as we can in the space before making a decision. And that way, it really allows us to understand the differentiation in the business models, who is the right founder to be approaching the problem. Because oftentimes you'll see someone who has a great idea, but they don't have the industry relationships. And one of the things that we loved about Patient is the founder had been working in hospital administration. He understood the problem firsthand. And so when we were backing him, we're like, oh, he gets it and he cares about it. Like, there's a deep passion about solving this problem, about improving the outcomes and lives of the people that he's providing financing to. And there were other people who were more transient of like, oh, this is an opportunity. And so like, how do you find people that are living and breathing that industry? So for example, for Spotter, Aaron, who's the founder, he's been working in the YouTube space literally since its inception. And he like so deep and cares so deeply about it. And Pablo, who's the founder of Produce Pay, which provides financing to farmers in Latin America. He, one of our portfolio companies we've been with for almost 10 years at this point, he was from a fourth generation farming family, right? So like, he cares deeply about this problem and is like so deep on it. I think that's one of the things that is really unique about our portfolio companies. I think you see this in a lot of venture ecosystem, is that you find these really deep domain experts who genuinely care about solving a particular problem and approach it through that lens. And that's where we've seen a lot of success from that sort of product and founder market fit.
I wonder when it comes to like, founding a successful venture capital firm, or like in this case, like a debt related firm, I guess, how does a portfolio construction look like in general? And when you are, let's say, for example, if you're like pitching to LPs, what are things that they would ask you to
Yeah.
kind of like demonstrate before, you know, to see? Because why I'm asking is I feel like this is very different than the traditional venture side of
Yeah.
things. I feel like in New York, there's a lot of different um, people, different firms that are focusing on like finance instruments, and like you guys are a lot more savvier than I feel like being living in Silicon Valley. We're focusing on like product driven things a
Mhm.
lot. I wonder what would be like the things that like people would care before they put money into the fund.
Yeah. I think diversification matters a lot because like we talked about before, you want to make sure that you built a fund that is durable and that doesn't lose money, right? In debt, the cardinal sin is you lose money because you can't make up for it in the same way that you can in the venture world, where you can have 100x that makes you all your fund. You just have to be very durable. And the big way that people lose money oftentimes in the credit world is lack of diversification, where you have one core concentration that becomes too big. And if there's an issue there, then it takes down sort of the rest of the portfolio. And so I think from our perspective, we like to keep concentration limited. And so oftentimes when businesses scale beyond our core fund, there's ways of bringing in additional parties to help work on those loans and making sure that we don't over concentrate ourselves in any individual position. And so that's honestly a very big piece of it. The other piece is like how much thematic correlation is there across the position. So, one of the negatives and positives of our fund is that there's not a lot of vertical specificity. So some people say, hey, you guys aren't specialized in anything. But the counter to that is some of the larger, we talked about a bunch of different investments, healthcare receivables, YouTube revenues, returns receivables, construction, like those are all relatively not correlated to each other, which we think builds a stronger and more durable portfolio because not one individual risk is likely to take down, the large positions in the portfolio.
In terms of like agriculture invoice factoring, like, can you elaborate more? Because I don't like, I feel like there are so many things in your portfolio that are like things that I've never really thought of as like potential portfolio, or things that like I've even like from being familiar with. So I wonder
Yeah.
why the problem would exist in that market, and then like like basically please inform us with like anything that I feel like in this industry that like we are not aware of.
So perishable produce is inherently a very difficult asset to lend against because it's perishable. And so like if you can't collect on it and it spoils, like your asset's gone. And so one of the main problems that were being solved were twofold. One, when a farmer is beginning their harvest and they're about to send boxes of produce to Whole Foods or Trader Joe's, wherever it is, they have to increase their labor force by like 10 times. And so they go from a small labor force to a bigger labor force as they take the crops off the vine, they put it into boxes, they take those boxes, they put them into trucks. Those trucks then go to the border and bring them into the US, right? So like that whole process is incredibly working capital intensive. But after that, it might be 45 days until Whole Foods pays the farm, right? It goes through a distributor and it goes back to the farm. And so during that period, they say our labor cost goes up 10 times, but it takes 45 days for us to get the money from Whole Foods. So they're like, all right, we need the money faster. How can we speed up that process? And so historically, the challenge has been it's a largely paper and pen operation. So as the produce goes through the supply chain, it's a truck driver who's getting a signature from someone in a warehouse. That warehouse person then hands it off to another person. It's all pen and paper. And so what Produce Pay had the insight of was if we can digitize the entire process of the supply chain and we can track the produce as it flows through the supply chain and get sign off from individual counterparties as it flows through the supply chain, we can make that a financeable asset. We can provide the farmers liquidity to solve that working capital need immediately as soon as we know that the produce is in the US, that it has an invoice from a Whole Foods, whoever it is, and then we can accelerate the payment back to the farm. And so that's, again, the use of data and technology to improve the access to financial services for a group of people who previously didn't have access to it. So they had that really strong insight. The other insight they had was pricing is really difficult to understand in perishable produce. It's not like, for specialty produce specifically, it's not like corn and soy where you have robust futures markets and derivatives and all these other things that you can actually hedge out risk and predict out what your pricing is going to be. Specialty produce is very, very volatile from a pricing perspective. And so what Produce Pay has done is they've actually created a marketplace and insights platform where you can track the value of produce on a daily basis and see what it's trading for in different markets with different distributors, different end buyers, different types of quality. And so that also gives you an ability to underwrite the value of the produce in a way that was not previously done before, because a lot of it was lagging indicators or there was intentional opacity. So distributors and could hold power over their growers. So there's a lot of data and insights that Produce Pay was able to generate to make this a financeable asset class.
Okay, so that's like so fascinating because I also don't know how to like I don't know, evaluate the assets of like, I don't know, like a dead corn or something. So like what
It's amazing. The whole thing has been super fun because You learn a lot about it. Again, it's the liberal arts approach to it. I went to like farms in Mexico, and I went to the border in like Nogales, Arizona, and McAllen, Texas, where a lot of the produce comes through. It's like you have like we just learn as we're going about a lot of these topics, and yeah, the amount of like asparagus that are in that can grow in a hectare. There's all sorts of like funny like metrics that you learn over time. But it's a very fascinating space that's massive. I mean, Mexico and Latin, I think, produce over 50% of the perishable fruits and vegetables that come into the U.S. So there's a huge reason for us to want to have stable cash flow and financing for those growers, because it's a food safety issue, right? Like it's a really important thing to have that supply chain continue to be a well-oiled machine. So it's a space that we like a lot and we're passionate about.
So what was the challenge there? So basically you're saying the perishable and stuff. Like, so I wonder like why would they need the debt and like why and then how would they be able to like return the investment?
Yeah, so the main issue is that they just have an increase in operating expenses for the period of time in which they're going to be generating all their cash flow, but it's delayed 45 to 60 days. So like
Mhm.
they're like, I know I'm about to get this money from Whole Foods. Whole Foods is a credit-worthy counterparty. If I could only accelerate that by 45 to 60 days, I could actually hire more people, get all the fruit out of the ground, make sure they have a smooth operation. And so it's solving like a temporary cash flow need. And the way they pay back is when it's a factoring arrangement, so it means that we buy the invoice, and then when Whole Foods pays back for that shipment 45 to 60 days later, it pays back produce pay for that amount. So like the grower is never really paying that amount back; it's always just going through the end buyer, anyways. And so from that perspective, like, all right, it's really important because we need to speed up how we're like realizing our cash. And then we don't want to have to deal with thinking about how we're paying it back. It's just going to get paid back directly from the buyer themselves.
Okay, so do you have to talk to the Whole Food team to set up a business account with them and then they pay to CoVenture?
It depends on it. So again, all of this happens through produce pay. So it's when I say we or us, like I think about like an
The
inclusive of
company.
produce pay, yes, as the company itself. And so they'll often have contact with those types of groups. Yeah.
Okay, so in terms of like for the margins, I guess like what would be, let's say, would it be like like what would be like the multiples that you are looking for as a return? And how do you, yeah, like I feel like I will finish one
Yeah.
question at a time.
Yeah, the multiple is an interesting one. I mean, like for us, it's an opportunistic cost of capital, and so our it varies depending on the asset. But we're always looking for something that has a premium to what a traditional version of that asset class might generate for coming in early, rolling up our sleeves, and being able to like help create value for that business early on. So there's a lot of different factoring businesses that have low cost of funds. We work with more nascent, earlier stage ones that are building up that track record and credibility so that they can get themselves to that point. And I'm being a little bit intentionally vague because I think the cost of capital varies a lot depending on the asset class. But we're underwriting, I would say, to a return that's a bit of a premium to what you'd see in the asset-backed credit markets, some more publicly traded stuff, to generate alpha.
Um, okay, so let's talk about, let's say, like the YouTube advertising revenue related things. Can you unpack a little bit more about like how do you guys work with this industry in general?
Yeah.
And we, of course, we have briefly chat about Spotter's success of this. So can you
Mhm.
give the audience a little bit more knowledge about like how the money flow in the YouTube
Yeah.
ecosystem and how does this company play their part in the ecosystem?
Yeah, for sure. So they've built a really strong network of creators they work with, and I think they've established themselves as very much creator first. How do we provide the best experience to the creator? How do we enable the creator? And they've done things. I mean, they announced it recently. They helped get Mr. Beast in touch with Amazon to get the Mr. Beast Amazon show. They've helped other creators get in rooms and create deals where they're just being a friendly participant and helping and supporting the creator economy. So they're deeply passionate about that. Well, the way that YouTube works, just to take a step back, and you probably know this well since you have a YouTube channel, but YouTube is an ad platform, first and foremost. And they allow the YouTuber to collect 55% of the revenue generated. and YouTube takes 45%. It's a little bit different on shorts, but for long form is the primary monetization tool. The way that YouTube generates money is through its ad auction. And there's programmatic ads that are run. And even if they're skippable, they have a certain monetization effort there. And so that could be anywhere from, $1 to $20 or $30 per thousand impressions that's generated to an individual creator. And these numbers are sort of publicly available. And it's less or more depending on sort of the quality of the creator, the type of audience that they're targeting, the value of those customers, and so forth. And so that's just the baseline. And so every month, a creator receives a report of like, this is how much viewership, this is what the revenue per thousand impression was, and this is how much revenue you're generating on those videos. And you can see on a video by video basis what the profitability attribution is. And so in that way, you have your content management system, which allows you to track and monitor the performance of your underlying videos. And so because there's this immutable ledger of the performance of the videos, it's unlike other types of small business lending. So if you think about making a loan to a corner store or like a random small business, a lot of the information that's reported is self-reported. So it's from the QuickBooks, it's from the information. It's like, who knows if their bookkeeping is correct, if they're doing it accurately. For YouTube, you just go into the back end, you authorize to see the information, and you can see all of the historical viewership and revenue data for all of the videos going back to inception for that creator. And so that means that you've eliminated like fraud or incompetence risk of the financial reporting that you do when you underwrite to an individual consumer or business. And so that's like a really key data point of like, you have this really pure data set that you're able to use to underwrite exactly how the go forward performance is and on the historical performance. So that's a really important piece that goes into it. And the other piece is, who are the people that are going to be the big creators going forward? And that's why these creators are taking the advances, right? They're looking and saying, I am betting on myself. I know that if I could give myself X amount of dollars today, I could invest in better equipment. I can invest in a team. I can invest in a facility that allows me to continue to scale up my production, which is great for the creator and great for Spotter, right? Because they know that as those creators grow, they can be repeat customers. They can continue to provide more forms of financing, more tooling, more efforts, and helping even beyond just the capital piece and relationships and introductions with advertisers, with potential, media deals and so forth. And so they'll provide these financings and collect directly from YouTube. And so YouTube pays out, T plus a certain number of days after the end of each month. And they'll get to collect the receivables, the revenues for each month directly from YouTube. So it's a great platform for the entire ecosystem. And I think it's been a huge reason why a lot of these creators, especially at the top end, have grown so significantly, because now they have the ability to capital plan and budget utilizing this capital from Spotter that they previously were waiting for on a monthly basis for that cash flow to come in.
I wonder, I think that's such a really interesting business, but like, how do you pick like which YouTuber that you would like to work with?
Yeah.
And like, I guess like, is there a massive amount of money goes into these production? Because I could only think of like Mr. Beast or someone who is very out there producing these like very big dramatical scenes. He's basically like a Netflix at this point. So like I wonder for like a regular content creator, like I may need like a better camera, but that's gonna cost me like under $1,000. So like I think like it's a lot less could be like a lot less lucrative business, as like if you're coming in as a third party to offer me $1,000, I pay you, I don't know, X.
Of course. Yeah. So I mean, it ranges completely, and Spotter is the one who makes the determinations, right? Like they're really deep in that creator ecosystem, and they work with the creators, right? It's like Colin and Samir are the ones who are like the creator's creator, right? They talk about what it's like. So like those are the types of people they work with, because they know that these people understand it, they get it. So Mr. Beast is publicly a customer of Spotters. They've worked with him a lot. And he's the great example, right? Because it's like, I'm going to blow up $800,000 of fireworks. Okay, well, that's working capital intensive, and there's a J curve to recovering your expenditure on that video, and you get paid back over time, but it is expensive to produce. And we've seen it with other creators who have had different use of proceeds. I think hiring a team and building out a team has been a very large one of like, all right, if I could add people to my team, I could actually create more content, and that's going to allow me to scale. So I think that's been one piece, like getting facilities and like renting a facility, buying a facility. And so there's certain expenditures that exist even across the spectrum, whether it's a smaller creator who might be making mid 6 figures a year to creators that are making, mid 8 figures a year. So it all just depends on sort of the type of creator, what they're solving for, but there's always some capital need for people that are trying to sort of hyperscale their platforms.
I have a question there. So
Yeah.
when you like, how big is the actual market for this type of things?
Yeah.
Because I feel like this is just like most people don't know how to. I feel like as a content creator, I went through the journey of like actually thinking about if we should build a team. But like the biggest fear is like, okay, so what if we don't make the money back? What if like this investment goes to completely vanish? Because
Yeah.
there is, I feel like it's kind of like a VC investment to a degree because it's a hit or miss. It's like you are creating a consumer product to a degree, and if the consumer product doesn't really take a giant, doesn't ride like a giant wave, like it's really hard to take off. And I wonder, as for investment, like let's say if you invest in like a company or invest in a team that doesn't really like take off, or like their video just like underperform, um, what would be the downside for the creator, or like what would be the things that you would take from the creator to make sure your investment is still in, everything is
So,
under control?
so I think that's one of the benefits of this. And again, Spotter is sort of the platform that manages it. And like um, the simplicity of the deal is it's like a license agreement. And so the creator is essentially saying, all right, I'm giving up the rights to these certain, these certain videos. But there's not like, it's not like you go to jail, it's like, not like there's issues if you don't pay, it's not a
Okay,
loan, right? So,
that's great.
yes.
So we don't go to
Yeah.
jail. I'm just kidding. So
No,
that's like a great takeaway from
yeah,
today.
the recourse is to the videos that were licensed, and so right, like as long as you're continuing to hold up your end of the bargain, there, it's one of those things that you're not taking on debt, you're not taking on some sort of equity that allows someone to take over your business. Like it is a intentionally made for creators so they can say, all right, I'm going to get this capital, I'm going to focus on creating. I'm not going to focus on having to like manage an investor, manage debt, manage equity, whatever it is. It allows them to like stay really focused on creating.
So what is a I guess like for the license agreement, just like people would be
Yeah.
able to take away, like people have ownership of the video, right? So they could like use the video however they want, but they don't take away your whole team or your whole company.
No. Yeah. And I have to be careful a little bit too much of what I say, but
Okay.
like, cause this is more of Spotter's domain than I would say
Okay.
my domain. So, but no, it's the focus is really a creator first product. It's like how you get the creator capital in a way that they understand and in a way that they feel comfortable, that they understand exactly what the risk they're taking as it relates to it. And they're not just worried, night after night that they have to pay back this big loan. It's like, they've done it structured in a way that intentionally fits within what the creator is looking for.
Is there any education ecosystem for like the venture financing side of things to creators, or like is there any innovative things
Mhm.
that you've seen that's interesting? Because I wouldn't name names, but previously I've
Mhm.
encountered a lot of companies that are trying to create like a creator equity solution, YC for
Yeah.
creator web things. And I don't really know what's the outcome of it, but like it's obviously like we are not talking about them. It means like something. So I wonder what are things that you feel like is there like any educational program for like venture financing for creator related things?
Hmm. I think Spotter's done a good job educating the ecosystem. The thing that I've observed generally in creator is that it is a space that you have to approach in sort of one of two ways. Is one, you work with the larger creators and continue to like build relationship with them and help them scale up, and that can justify sort of the approach of selling into that network because it's so large. It's almost like an enterprise sale. And then you have like the tail of creators who might be part-time creators. They might be like trying to ramp up a business. And that ecosystem is a lot more fickle and challenged. And I think what you're pointing out is you can't really have a services intensive business to an ecosystem that is inconsistent or has a lot of churn. And that means that you have individuals that are spending time on creators who may or may not become large enough customers to actually generate enough revenue to justify those relationships and those services. And so my viewpoint is you either build the services and capital or scalable tech business for the largest creators, or you build a highly automated tech forward driven platform for the tail of creators. And so I think that might be like Linktree, right? Like that might be a link in bio type company that allows you to like use for the long tail. But then there's like, if you try to build a spotter for the long tail, that might be more challenging because it requires a little bit more hands-on work with the creator to like help them understand what the product is. And I think it can be a little bit challenging because it's not so like it takes a little bit of time to educate someone of exactly what's happening. So I think your point is very well taken, and that I think there needs to be a bit more education of like what are the options for creators, because it's still not perfectly clear. And I think it takes some time for creators to fully understand what the deal is.
I wonder, so like I want to switch gear a little bit. So
Sure.
you one of the third category of things I've not third category, but like one of the big category of things I saw that you guys invested in is like the Amazon 3PS aggregator space. You also did a wonderful podcast with some other people on like I feel like I'm so educated after watching the video. But I wonder, can you, for the audience who maybe not be familiar with the space, like I wonder how does how does your investment come into the place, and like how does the existing ecosystem work in the Amazon 3PS aggregator space?
Yeah, so it's been a very turbulent ride, I'd say, in the Amazon ecosystem, and a lot of it's driven from supply chain issues and Amazon increasing their fees and other things along it. But Amazon fundamentally, it's not dissimilar to our thesis around YouTube. It's like Amazon third-party sellers were like a $300 billion market size. So you're like, holy smokes, that's like a massive, massive, massive market size in business. And there's not financial infrastructure to support it. And so it's another space where like, all right, there's clearly an opportunity to help these businesses scale and grow. There's clearly a need for capital, and there's clearly an ability to provide capital just based off of how large and profitable some of these businesses were. And so we spent some time looking at it and figuring out like what was the way we wanted to approach it. There are a number of companies that were going and acquiring some of these third-party seller businesses for low multiples. And the market was growing incredibly quickly. There was obviously Thrasio was a large player in the space. They had raised a few $1 billion of capital from large private equity funds. There was a number of other businesses that became unicorns in very short order by acquiring these businesses, integrating them, and scaling them up in a roll-up fashion. The challenge is, like I mentioned sort of at the beginning, is supply chain issues, inflation, Amazon increasing their fees really squeezed sort of the margins out of a lot of these businesses. It made it more challenging to operate the businesses at scale. And I think like a lot of overheated markets, things grew really quickly, things got a little bit overheated, and then you see sort of the natural evolution of the space over time. So like Thrasio filed for bankruptcy, and there's other instances of that in the market. But generally, I think we're long-term believers that Amazon as a platform is very, very important. There's Temu and there's Shein and there's all these other platforms that are coming in and competing in some way, but Amazon remains durable. They remain growing. They remain scaling up. And so it's an ecosystem that continues to show that there's going to be money made on it for its creators, or whatever you want to call them, merchants. But it's one of those things that I think has to be done in a different way than was previously contemplated. Now, there's plenty of companies that did the Amazon aggregation thesis where they were able to be successful, largely around vertical integration, largely about vertical focus. But a lot of it was an overheated market that got hit with some macro issues and then issues from a platform perspective. So it's been an interesting one that we spent a lot of time on. We're still bullish long-term that Amazon's a very interesting platform, and that there's going to be a lot of money generated from the platform itself for its sort of stakeholders. But obviously that particular space has faced a pretty strong headwind.
I wonder, so since like you invested in a company called Aquaco, so I wonder, can you walk us through like what's your thought on the company, and that why did you guys decided to partner?
Yeah. So the business was founded by an individual named Ronik. Ronik had founded and sold a number of Amazon third-party seller businesses. And so he had proven that he'd been able to run these businesses profitably. And there's a certain skill set that had been built up over time where Amazon is its own complete different universe. Like you can't just go in
Mhm.
and expect to figure out how to, SEO your way out of the problem. It's like you really have to understand how relations with Amazon work, how to manage your price per click, how to manage your copy, how to manage your photos, like every little detail, your sourcing. And so you needed someone who actually had that background and understanding of how the platform worked to build
Mm.
a successful business.
Mm.
And so we liked finding founders that had a lot of domain expertise and understood how to operate on those ecosystems. And so building around that was just like a team of people who could help scale that from a one or two brand portfolio up to a let's say 15, 20, 25 brand portfolio. So the idea was put capital behind someone like that to help them go out and acquire, use their expertise to scale up and improve the businesses.
Mm. What would be the businesses that like they would, let's say, like what kind of traction would the business be before they kind of partner with these businesses? And then
Yeah.
how would you like, I guess, like how would you guys like just in general just like fund the Aquaco as a business to go and acquire? So it's acquiring
Yeah.
businesses, they are kind of like core strategy, so that like acquire and help them scale off, of course. But yeah.
Yeah. Acquiring and then asset managing them. And I would say it ranged. So it could be anywhere from a $5 million revenue a year business to a $50 million revenue a year business. And it just depended on the sort of the characteristic and qualities of that platform. But a lot of times it was growing businesses that had very strong barriers and moats. And so within the Amazon, if you ever search on Amazon, you look up shower curtain liner. And if you look at the first product, it's actually one of their products. And it's got whatever 200,000 reviews and 5 stars. And so you're just going to buy that shower curtain liner, right? It's like that's how you work as a consumer. Now Amazon has changed sort of the dynamic and how people shop with putting too many ads at the front of it. That's a whole separate issue. But generally, the idea is how do you find high quality, well entrenched products that are almost like annuities, where like you have that top ranking position, and when people go and search that keyword, you're going to buy that product.
Mm. I think previously we also chat about like, companies like Clearbank. I know that you guys are also collaborated with them, and I wonder, um, how would the collaboration, like, I guess, like how would a Clearbank work with you guys? And
Mm.
since like I feel like your company is so interesting because you guys kind of like tap into various different industries, and I wonder if there's any trends that you could share with the audience on like if they are, let's say, an emerging manager or if they're angel investing, what are things that they should look for based on the industry insights that you have learned from,
Mm.
doing your business?
Yeah, it's definitely interesting. So like for Clearbank example, like we worked with them from 2017 through last year. So we long relationship with them, and their product evolved over time from funding Airbnb hosts to funding
Mhm.
e-commerce companies,
Mhm.
and so like we would work with them, right? We'd help them scale up their business and finance the underlying platforms that they're working with. And so they were someone that would be a customer of ours, right? Or was a customer of ours. And I think like that's, we like working with platforms that are scaling and have a lot of equity behind them. And so that's a perfect sort of example. To answer the second part of your question, it depends, right? Because I think like what makes a very attractive early stage debt investment might be different from what makes it a really attractive equity investment. But what we found is there's a pretty interesting thesis of like there's venture scaling businesses that don't necessarily look like venture backable companies,
Mhm.
and that's largely because they have a big balance sheet. And so we've found a lot of businesses that have scaled up really quickly through the use of acquiring assets that might not have otherwise been observed by the venture ecosystem. And so sometimes it's saying something is venture scalable, even though it doesn't feel venture backable. But there's a variety of different areas that we've been spending time in. Obviously, the multiples for SaaS businesses and payments businesses exceeds the multiples you typically see for specialty lending businesses. And so we are like finding companies that are a blend of the two in certain instances. So like Return that I mentioned, it's a software business with that had a capital angle. Patient, similar idea. It's like software business with a capital angle. And so how do you merge those two know-hows together, create stickiness with capital, and then create recurring revenues from that stickiness of capital and generate revenues over time. And so that's like sort of, I guess the term is embedded lending. We're still sort of evolving over time, but there's a lot of really interesting opportunity there if you can really find interesting platforms. And one of the things we like to say is like, what are the switching costs once you're in? And what's the alternative to taking a deal from that company? If the alternative is no deal, that means you don't have any competition, and it means that you probably are going to be a pretty attractive origination vehicle. And so those are the businesses that we think are creating the most value and are most exciting to us.
Mm. Okay, so I wanna, since like we're closing to the end of the interview, I wanted to have like a 1 minute fire off with you. So
Okay.
okay, so first question, what's your favorite book?
Oh, wow. Favorite book. That's, I'm sorry. I wish I had a better answer off the top of my head. I feel like I recently read Tiny Habits, which I really liked. So any like social psychology book, like Predictably Irrational or anything along those lines are always really interesting to me.
Who made the biggest impact in your career?
I would definitely say Ali, the founder that I work with now, like just getting to work with him for the last 10 plus years.
Who will you invite to your dinner party?
I feel like Larry David. I'm just so curious about him.
Oh my god, I would invite him too. This is like a where can we find you outside of work?
Board game enthusiast, Settlers of Catan specifically. So there's a
Oh
lot
wow.
of board gaming. Yeah,
Oh my god. You would blend into San Francisco very well. I feel like
I've been told.
it's a table stake, like a board game enthusiasm for
Yeah, no, I think I got somehow during the pandemic got wrangled into it and like won a New York championship for Catan and like competed in the national championship. It was like a whole saga that we went through. So that's a story for another podcast.
Oh my god. Okay. Yeah. That's such a crazy thing. But anyway,
Yeah.
hi Jacob. I want to say, oh, okay, Jacob, what's your question? Okay, we have an audience question, and I don't think
Okay.
he knows the question yet. Okay, if he is not responding in the next like 10 seconds, we're probably gonna
Okay.
call it a day. Because typically people would, sometimes like the StreamYard system doesn't like really reflect the question on time. So we would
Mhm.
have like some people commenting on different channels, and then they just like don't show up.
I see.
Okay, sorry, Jacob. Like we'll answer your question next time. I
Mhm.
appreciate you. Okay, so Jacob, are you there? Okay, sorry. I think
All
I don't
good.
know. Okay, maybe it's just like bad traffic or something. Okay. We will end stream for now.
Cool.